What is the best time frame to trade on? I get this question asked a lot, and while there is no secret magical time frame that's going to get you the best results, in this video I'll break down step by step exactly what you need to do in order to figure out and determine the best time frame for you. Why? Because everyone is different. Whenever you pull up a chart, you'll notice that there are multiple time frames that you can possibly choose, and on TradingView, the software that I'm using right now, if you click on the little down arrow right here, you'll notice there are many different options that you can choose. You'll see the ones that I have bookmarked or selected or favorited right over here. But let's go ahead and figure out what the best time frames are to trade and the reason why I have these specific ones selected for myself. Now, when a brand new trader is trying to determine and figure out the best time frame to trade for themselves, they need to take into consideration multiple different variables. For example, the bigger time frames that you're looking at, these will be moving a lot slower than someone trading smaller time frames. What does that mean? That means the busier you are, the more things you have going on in your life. If you have a 9-to-5 job, if you have extracurricular activities, or if you even have kids and you have things that are going on in your life, those traders most likely are attracted to the higher time frames. Comparing that to someone who maybe has no job, maybe they have like all the time free in the day and they can trade for 4, 5, 7, 8 hours a day. Those traders might want to have more trading opportunities within that day and therefore might be attracted to the smaller time frames. So the first question you need to ask yourself is, how much time can I devote into trading on a daily basis? The general rule of thumb is it's more ideal to trade on the bigger time frames, the less time you can spend on the charts, and the more time you can spend on the charts. Some traders tend to go look at the smaller time frames. Now, just know that there's a lot of caveats to this. That's just one variable. There's other things that are involved in order to determine which is the best time frame for you to trade. Let's go ahead and kind of go down this list of time frames that I have bookmarked up here. So looking at the chart, a monthly chart, people that are in the markets, day traders, swing traders, and scalpers, we're not really looking at the monthly chart to put in trades, to activate trades. The monthly chart, each of these candles here gets formed every single month, meaning every month there's a brand new candle being formed. Notice on the right, this one shows this has 13 days and 18 hours left before this candle stops moving up and down and before that next candle gets created over here. So that isn't going to get you many trading opportunities and isn't really refined to a point where you can see exactly what's happening in the market on a day-to-day basis. Now, when someone gets into the weekly chart, you're able to see a lot more detail compared to a monthly chart. But just know, just like with the monthly, each of these little candles here are created once a week. So once this week finishes, a new candle will appear next week, and it's going to continue to move up and down until that next week is closed entirely. Now, not many people trade just simply only looking at the weekly chart either, because again, you're not going to have a lot more trading opportunities trading the weekly time frame either. But it is a good time frame to look at just to get a general idea of what's happening in the market in terms of a macro level. Now, the daily time frame, this will give you a lot more visibility and a lot more clarity of what's happening in the market, and it will give you more trading opportunities. This time frame, a lot of traders use that are a bit busy in their lives, and traders that just want like the cleanest setups, don't really want to have to interfere with any small little crazy movements in the market. But the daily time frame, because each candle is formed once a day, this does give traders ample time to carefully analyze the charts, make trading decisions, and it is slow enough to allow traders to trade multiple different assets, multiple different currency pairs, while still being able to juggle the multiple pairs at the same exact time. The type of traders that generally trade the daily time frame are generally the swing traders or the position traders. Swing traders being the ones who might hold their trades for like a couple days, up to like a couple weeks, or if they get like a really good trade, might hold it for maybe like a month. Position traders are the ones who will hold it a little bit longer time frame. Maybe might hold it for a couple months, maybe 3, 4, 5 months, maybe even like 6 months, depending on the full position that they want to take. If they see like a complete fundamental shift in the economy that's happening in the markets, if they see that the asset class is going to be bullish for the long term, they might hold that trade. They might buy a couple positions over here and just hold that trade for a long time until they see the macroeconomics change and go back into the bearish direction. And while swing traders and position traders look at the daily, day traders also do often look at the daily time frame as well. Going deeper into the 4-hour time frame, this is more for people who want to have more trading opportunities, maybe have a little bit more time on the hands, maybe don't want to juggle as many different currency pairs or asset classes that they want to trade at the same time. You're able to dial a little bit deeper and see a bit more market movement on a granular level. The type of traders that generally trade the 4-hour chart are usually either swing traders, day traders, and sometimes scalpers look at this just to get like a general idea of the market direction itself as well. Now, the 1-hour time frame, this gets a lot more deeper. This moves a lot faster than the daily time frame, because one thing we have to understand is 1-hour time frame, if you're trading the Forex market or even gold, one thing we have to understand in the Forex market, 24 of these little candles here, 24 candles equals 1 candle of the daily time frame. So for example, maybe like a day trader that goes to sleep over here and then 8 hours go by, all these 8 candles will appear by the time they wake up 8 hours later. So it's a multiple, you get to see multiple candles being formed 1 hour after the other. While someone who looks at a daily time frame, by the time they go to sleep and wake up, it's generally the same candle that's still being painted, because that's on a 24-hour period. Now, going a little bit deeper, and by the way, quick little tip on TradingView, you can just simply type out a number, for example, like 15. That just quickly is a shortcut to change the interval that you're looking at on TradingView. So just typing 15-minute time frame. This is a lot more granular. This is where day traders and scalpers mostly spend their time on this time frame, or some scalpers even go deeper into the 5-minute time frame, and then even maybe the 1-minute time frame as well. You'll notice this has a lot more action, a lot more things happening. And you can just even imagine looking at the 1-minute chart. Imagine each of these little lines here, these little bars, is a brand new minute. You can just imagine 2 hours of not even looking at the chart. It's just a completely different chart. 2 hours back, even more, it's just a completely different chart. So there's a lot more madness happening in these smaller time frames. That is why personally, I don't trade the 1-minute time frame. It's a lot more fast paced. You have to be on the screen a lot longer. And it does take a lot of time out of your day in order to follow things that are happening. Now, personally, I am not a scalp trader. I am not a scalper. So I stay away as far as I can, personally, from the 1-minute time frame, the 5-minute time frame, the 15-minute time frame. Those are time frames that I personally do not trade, because in my opinion, it's just not worth it. Now that we have all of that established for the time frames, let's get a little bit deeper into the explanation. So the next variable we need to take into consideration whenever we're trying to figure out which chart that we want to be looking at is, in general, how technicals work, just how technical analysis works just in general. The strike rate, the win rate, the accuracy on the trades, whether technicals will hold or fail, the accuracy, the win rate is a lot higher generally on the higher time frames, and the lower time frame that you go down into, the less and less and less probability you have of those technicals working and those technicals holding. So in other words, in general, traders have a higher win rate on the higher time frames and a lower win rate on the smaller time frames that they go into. So that being said, what you need to figure out as a trader based on your risk profile is twofold. Number one, what we talked about before is what does your schedule look like? How busy are you, and what time frame can you handle based on the speed that the candles are appearing on the chart? The second variable we need to take into consideration is how high of a win rate do you want, and compare that and balance that to how many trading opportunities do you want and at any given time as well. So let me explain what I mean by this. We know on the monthly time frame, if someone is trading on the monthly time frame, you might be entering maybe 1 trade per month. You might even have a few months that you are just sitting on your hands. You're not doing any trades. Why? Because the market has only moved a small amount compared to the previous candles. So you might have months that you're not taking any trades, whereas the weekly time frame, you'll have a little bit more trades. Maybe you're taking a couple trades a month, so you have more trading opportunities, but the technicals will hold a little less compared to the monthly time frame. As you dive deeper into the daily time frame, you'll have a lot more trading opportunities. You might be trading 2 to 3 trades or maybe 4 trades per week, but your win rate, your strike rate will be a little bit less as opposed to the monthly time frame. And the deeper you go, 1 hour time frame, you'll have a smaller win rate, but you have a lot more trading opportunities, which you can still be profitable even with a less of a win rate, simply because you have a lot more trading opportunities. Now, let me just throw some random numbers into this just so you can put this into perspective, right? So someone trading on the monthly chart might take maybe 5 to 10 trades in the entire year, but they might have a 90% win rate. So the question a trader might ask themselves is, taking those 5 to 10 trades in the entire year, but most of my trades are all going to be right, is that going to give me the amount of growth, the type of growth that I want in my account? Someone on the weekly time frame might get a lot more trading opportunities, maybe trade 25 to 50 trades in the entire year, and they might be okay with a 75 to 90% win rate. And in fact, even though they have a lower win rate, they even might make more money than the trader that has a 90% win rate, simply because they're entering a lot more trades, because they have a lot more trading opportunities. So even though they have a lower win rate, their account still has a higher equity growth curve. Now, while the trader who's trading on the weekly time frame mostly might trade 25 to 50 trades in the entire year, the daily time frame trader might have 25 trades in a single month. Maybe they have a win rate of 65 to 75% win rate. Maybe that trader is okay with that lower of a win rate because they have a lot more trading opportunities compared to that weekly time frame trader. Now, going down deeper into like the 1 hour chart, maybe they have a lot more trading opportunities. Maybe their win rate is a legit 50% win rate, and maybe they are profitable because their risk to reward ratio is above 1, so their account is still growing, and because they have a lot more trading opportunities, their account might be growing faster than maybe the weekly time frame trader or even the daily time frame trader. And maybe their account isn't growing as quick as the daily time frame trader, but maybe they love the 1 hour time frame and they just love having a lot more trading opportunities. So the balance that you need to find, and the only way you'll ever figure out what your balance is for you, is trade multiple different time frames and see over a long period of time what your win rate is, and then how anxious you are to enter more trades. So that way you kind of work your way down and figure out what type of time frames that are the best for you based on the win rate, and then based on the amount of trading opportunities that you want with the type of lifestyle that you live and the type of risk profile that you want to have as well. So now the question is, why do technicals hold a lot better on the bigger time frames as opposed to the smaller time frames? Well, the reality is how the markets move in general, it's based on buyer activity and seller activity. Let's go ahead and go to the monthly time frame. I want to ask you guys a question. Since each candle is 1 month worth of time, this candle right here, this little peak right here was created, look at the bottom of the screen, it was created in August of 2020. So from here all the way until today, how long has it been? It's been quite a few years since this candle has created. So do we agree that a lot more eyeballs have seen this peak over the course of the past few years? Pretty much almost everyone that trades gold has seen this peak. Anyone that trades gold consistently has seen this peak. Anyone that trades gold for the past 3, 4, 5 years has seen this peak for sure. So this is a key level. This is a key point that a lot of traders have marked in, because the price, in this case, gold, has had trouble breaching this price point right over here. So what's going to happen? Let's go a little bit deeper into like the weekly time frame. So what's going to happen since the price had trouble breaching this area once? Traders know the next time, since the price had trouble breaching this price the first time, traders know if someone took a buy here, let's say you took a buy down here, would it be wise for you to put your take profit at this point or below? Or would it be wiser for you to put your take profit somewhere up here, above that zone, above this exact price point over here. Which one would be wiser, to take your to close your buy position down here somewhere, anywhere down here, or would it be wiser to close your trade up here? I hope everyone watching this video can agree that it would be wiser to close your trade before the price reaches this area right over here. Why? Because the price at one point back in 2020 had trouble breaching this price, this price over here. So it might have trouble breaching that price here a second time. That is why this zone has been created. It has essentially created a key level, or in other words, a resistance area. So if you, the smart trader, is going to take profit at that point or lower, do we agree that once you buy something, once you buy gold, that's the action of you starting the trade, you must then at one point close the trade, which is meaning you're selling it back, which is why they say buy low and then sell high, right? So let's say you close the trade, which is the action of you selling it. That selling pressure is slowing down the price action, and new sellers that are coming in the market, traders who trade reversals, reversal traders, those traders are seeing this area and saying, you know what, the price had trouble breaching it last time, so let me go ahead and enter a sell position here as well. So the double strength of buyers closing their longs and then brand new traders entering shorts, the double action of sell pressure creates that self-fulfilling prophecy, what is known as technical analysis. That is why technicals work a lot better at longer time frames, because a lot more people, a lot more eyeballs have seen this area, and a lot more people, smart money, institutional traders, see this level as a hard point to breach. So institutional money is going to close their longs prior to breaching this level over here. So now let's do the other extreme. Let's go into like the 1 hour time frame, maybe a little bit more extreme. Let's do like the 15-minute time frame. If pretty much everyone who trades gold has seen that spike back in 2020 of the monthly time frame, if pretty much almost everyone has seen this spike over here, you need to ask yourself in the 15-minute time frame, what is the number of people? What is the percentage of people who have seen something like this spike over the course of, from when this candle started? You can look at the time over here, from when this candle started at this exact time until today. If you look at the timestamp, that's from April 12th all the way to April 14th. That's 2 days worth of time. Not every trader is looking at this exact candle and analyzing their setup, their trades based on this exact candle over here. So there's a lot less eyeballs, a lot less self-fulfilling prophecy of technical analysis goes into the smaller time frames. And especially if you're looking at something like the 1 hour time frame, a lot less traders are looking at the 1 hour time frame at this exact candle, at this exact time, trading this exact pair at the moment that you're trading the pair. So technicals work less, but you do get a lot more trading opportunities when the technicals do work. Because in this example, on the 1 minute chart, this candle was created on April 14th. And then right now it is still April 14th. So only a few minutes have passed from this candle all the way to this candle here. Now that I've given you both of the extremes, the monthly time frame and the 1 minute time frame, you need to find out what the best balance is for you. Now that you've understood these very important concepts, I'm going to tie this whole video together to tell you exactly what you must do when it comes to trading the markets here. You should not look at any one specific time frame. It is very important that you keep your eyes on multiple time frames, because you don't want to get blindsided or have your blinders on looking at one specific time frame and miss clues that could help in your trading based on various other time frames that could help you out in your trading as well. So for example, we can notice looking at the chart on gold that the overall, the macro trend has been bullish, has been going up, has been going in the up direction. We go into the weekly time frame. We notice that the price has been consolidating over the past few years, but as of recently, the price has been extremely bullish. But then we can also notice and also understand that we do have a few points of resistance that might affect the trade in the short term if the price does approach these levels over here. So that is still something that we need to take into consideration, because if you're trading on the 1 hour chart, guess what? You're not going to see this zone. You're going to be looking at this chart over here, and you're not even going to realize that there is a zone up there because that zone is not visible on the 1 hour chart. You're going to need to back up a little bit, look at the macro level, and notice that there are a few spikes over here. So let me go ahead and draw these back again for you. Going into the daily time frame, you'll be able to see that these zones are here. And you'll notice that the price is bullish as well. So you need to ask yourself, what direction should I trade? What direction, just in a general sense, should I be trading? Should I be looking for a short right now? Or should I be looking for a long? Well, one thing you can tell yourself is you should probably be looking for a long because the market is going up. But then on the other end, if you do take a long, if you do take a buy, you might consider taking partial profits. You might consider closing part of your trade when the price reaches this area, or you might even consider closing the trade entirely when the price reaches here. That's all based on the technicals that you want to deploy in your trading strategy. Then when we go into the 4 hour time frame, we notice the price is still going in the up direction. So even the 4 hour time frame is having a confluence telling us that over the shorter term, the price has still been ascending upwards. And then going into the 1 hour chart, we noticed that the price did have a huge, massive drop, but the price did indeed rebound. So when we're thinking to ourselves, possibly we should be looking for a buy, looking for a long, and we can ask ourselves in the 1 hour time frame, did the price retrace enough for us to get a good position, a decent position to allow us to buy gold at a discount before it possibly continues to go up? Notice how all of these different time frames work together to give the trader a technical outlook of where the price might go based on the different levels that's happening in the different time frames that you're looking at. Now, by the way, just know that technical analysis doesn't give you the entire picture, but we also need to take into consideration what's happening in the fundamental analysis level as well, because that was just straight up technicals. But if something bearish happens and causes this price to break down right here, some of these technicals might not even hold. And if bullish news comes out, this technical level might not even hold either, and the price might continue to go up. So while technical analysis does give you an idea of where to put your buys and your sells and where to put your take profits, that's just part of the picture. In order to have a full entire picture of the market, some traders employ fundamental analysis to get the entire picture of what's happening, to get a better understanding and increase their odds of having their trades hit take profit and less trades hitting their stop loss. And for those of you who want to trade the exact same strategy that I trade, there should be a link in the description to book a call with me or someone on my team. We'll take a look at your trading, kind of see where you're at in your trading level. We'll interview you. We'll see if you're a good fit. And if you are a good fit, in our private members program, we go over fundamental analysis for 2 entire weeks. And then I show you everything you need to know in order to dissect the markets based on what's happening in the markets around us. And then we'll spend 2 jam-packed weeks talking about the exact same way that I use my technical analysis in order to get the best sniper entries, in order to maximize the amount of trades that you get right, in order to maximize the profits that you get, in order to minimize the amount of losses that you get in the market, so you can have the best opportunity to increase your win rate and be able to grow your account. That being said, I hope this training was informative for you. Use the things that I told you in this video to determine the best time frame for you. Have fun with it. Don't rush things. This is a learning process. It's okay to fail. It's okay to get better. That is how we improve in life in general. That being said, if you did find this video helpful, feel free to share this video in your trading groups, in your chat groups. Drop a thumbs up if you haven't already. And if you haven't subscribed yet, feel free to subscribe, as I will be releasing a lot more training videos in the upcoming weeks and months. Take care, guys.